Hi, everyone. Welcome to CFRA Thematic Insights, where we explore the market trends and investment themes shaping tomorrow's opportunities. I'm Sel Hardy, Senior Vice President of Equity Research, and I'm joined by Daniel Rich, Senior Equity Research Analyst. Today, we will be discussing here our recent thematic report about healthcare stocks as defensive plays during a volatile energy price environment. On the next slide, you can find here a quick disclaimer. On slide 3, let's talk about the healthcare sector's outperformance in prior periods of oil shocks. We are currently in this uncertain period with elevated energy prices. Historically, oil price shocks have triggered recessions and bear markets. As you can see in this graph, most recent examples include the 2008 financial crisis, the 2011 Libya crisis, or the 2022 Russia-Ukraine situation. The recent conflict in Iran and disruptions in the Strait of Hormuz caused a 40% jump in WTI crude oil prices. We think that a prolonged oil shock could be a major risk to the economy, while the duration of the crisis remains highly uncertain. During these periods, however, we see that healthcare stocks significantly outperform the broader market, showing some resilience. Don't you think, Dan?
Yes, that's correct. So we think that healthcare has several fundamental characteristics that make the demand for products and services relatively stable, regardless of economic conditions or geopolitical uncertainty. Medical care and prescription drugs are necessities rather than discretionary purchases. People will continue to spend on healthcare when they're sick or managing chronic conditions, whether the US economy is strong or weak. Of course, it's unclear right now whether the current environment of higher energy prices will be short-lived or persist for a long time. Although we do not see elevated oil pricing benefiting healthcare through accelerated sales or higher profitability, we do note a few areas that could remain well positioned to outperform peers during this environment, Sal.
That said, higher oil prices may negatively impact the discretionary segments within healthcare by increasing recession risk and weakening consumer confidence. Discretionary healthcare products and services are those that aren't urgent or immediately life-threatening, where patients and providers have time to weigh options and make choices such as cosmetic procedures and non-emergency mental health services, for example. So moving to slide 5, we wanted to highlight biopharma as we see this healthcare sub-industry as relatively more resilient compared to others. Pharmaceuticals are naturally defensive because prescription drugs, especially for therapy areas like cancer, immunology, and chronic diseases, have low price elasticity. People need these medications. In our thematic report, we cited data from Evaluate Pharma that you can see here, showing worldwide prescription drug sales growing at 7% annually through 2032 and reaching nearly $2 trillion. Our report specifically calls out Eli Lilly and AbbVie as expected to be the top 2 prescription drug companies by 2032. We also have a favorable view on Amgen, Bristol Myers Squibb, and Merck. All of these have strong exposure to high growth areas like oncology, which is expected to grow at 10% annually and represent 21% of all prescription sales by 2030. Cancer cases are rising globally due to aging populations, lifestyle changes, and urbanization. The US alone saw 2 million new cancer cases in 2023, and by 2050, we could see 35 million new cases worldwide. As people live longer, cancer incidences rise, and it means consistent demand for these therapies. On the next slide, you can see a summary of our top pharmaceutical and biotechnology topics across our US, Europe, and Asia coverage. So turning it back over to you, Dan, what are some of the other areas within healthcare that could be well positioned for a volatile energy price environment?
So we really like drug distributors, specifically the big 3 of McKesson, Cencora, and Cardinal Health. Together, these 3 companies are estimated to have over 90% market share of all US drug distribution. Distributors operate on a fee-for-service basis, so they can typically pass through their cost increases and help protect their profitability in inflationary environments. We also think that distributors benefit from similar secular trends that impact the pharmaceutical industry, including long-term demand from aging populations in developed markets and expanding middle classes gaining access to healthcare within the emerging markets.
That's interesting. Any other names you would like to highlight?
Yes, so within the life sciences tools and services sub-industry, our report highlighted IQVIA, which is an integrated clinical research organization and a healthcare information services provider. The company does not manufacture or ship any physical products. It provides services to pharmaceutical companies for clinical trials and data analytics. We like that the company has a significant revenue visibility through its large contracted backlog in the research and development solutions segment. We also like that the company is growing its decentralized clinical trial capabilities using telemedicine and virtual technologies. And finally, we highlighted DaVita, which is a healthcare services firm providing dialysis treatment for kidney failure patients. Dialysis is a life-sustaining treatment. You cannot postpone it or cancel due to economic conditions. While oil prices could make it more expensive for patients to travel to dialysis centers, we note that many patients have Medicaid coverage that includes non-emergency medical transportation. And so that is all that we have for you in this video. Thank you very much for your time today. For more information and to view our full report, please visit the website marketscopeadvisor.com.